Hello everyone and welcome to my channel Compliance Lookup. In today's video, we will be discussing important topics international guidelines and standards. In the earlier chapter, we learned money laundering and global measures. If you have not watched then please watch lecture 3 of this playlist. These topics are essential for financial security and in future videos we'll dive deeper into how these procedures are implemented, the tools used and the real world impact they have on businesses and individuals. If you found this video helpful, don't forget to like, share and subscribe for more content on financial compliance, regulations and more. International guidelines and standards are established by global organizations such as the UN, WHO, and ISO to maintain quality, safety, and uniformity across various sectors. These standards assist countries in adopting best practices, enhancing trade, and ensuring safety. By adhering to these guidelines, products and services are aligned with international benchmarks, fostering trust and collaboration on a global scale. Now coming to this, the Basel Committee on Banking Supervision (BCBS) is an international body that provides guidelines and standards for banking regulations to promote financial stability across the global banking system. Established by central banks and regulators from major economies, the BCBS develops frameworks like the Basel Accords, which set out rules on capital adequacy, risk management, and supervisory practices. The goal is to ensure banks maintain sufficient capital buffers and manage risks effectively, thereby safeguarding the stability of the financial system and preventing crises. The prevention of criminal use of the banking system for the purpose of money laundering December 1988 was a significant initiative by the Basel Committee on Banking Supervision to safeguard the integrity of the financial system from being exploited by criminals for laundering illicit funds. The framework, which was later superseded by more comprehensive regulations, aimed to establish guidelines for banking institutions to prevent money laundering activities and maintain the soundness of the banking system. Overview of the 1988 Basel Framework. The 1988 guidelines were part of the Basel Committee's efforts to strengthen the global banking system and prevent financial institutions from being used to facilitate criminal activities, particularly money laundering. Money laundering involves the process of making illegally obtained funds appear legitimate by passing them through the financial system. The Basel 1988 guidelines were initially aimed at 1. Preventing banks from being used to launder the proceeds of crime, especially from activities such as drug trafficking, corruption, and fraud. 2. Establishing anti money laundering AML standards within the banking sector to enhance the integrity of global finance. 3. Encouraging banks to establish due diligence procedures to monitor transactions and prevent criminal activity. While these guidelines were foundational in the fight against money laundering, they were relatively basic and lacked the comprehensive approach seen in later frameworks such as the FATF 40 recommendations and Basel's subsequent guidelines. Key principles of the 1988 Basel Framework. 1. Know your customer KYC. All principal banks should verify the identity of customers before establishing a banking relationship. This ensures that financial services are not provided to criminals or entities involved in illegal activities. For example, before opening an account, banks would require customers to provide identification documents such as a government issued ID or passport and proof of address to ensure that the person requesting an account is who they claim to be. 2. Suspicious activity monitoring and reporting. All principal banks should have systems in place to detect unusual or suspicious transactions that could indicate money laundering. If suspicious activities are identified, banks must report them to the relevant authorities. For example, a bank might notice a customer depositing large sums of money without any logical explanation for the source of funds. In such a case, the bank would be required to file a suspicious activity report SAR to alert authorities, even if the customer claims the money is from a legitimate source. 3. Record keeping. Principal banks should maintain detailed records of customer transactions and related activities for a certain period, usually 5 to 10 years. This allows authorities to trace the movement of illicit funds if needed. For example, a bank might keep records of wire transfers, including the sender's and receiver's information, the transaction amount, and the date, which could be used later in an investigation to track the source of criminal funds. 4. Training and awareness. Principal banks should train their employees to recognize signs of money laundering and educate them on how to report suspicious activities. For example, banks would organize regular training sessions for employees to help them spot warning signs of money laundering, such as unusually large cash deposits or transactions involving high risk countries. Employees would be trained on how to file SARs when necessary. 5. Internal controls and compliance programs. Principal banks should have robust internal controls and compliance programs in place to ensure adherence to anti money laundering laws and regulations. For example, a bank might establish an AML compliance department responsible for overseeing all aspects of anti money laundering efforts, including monitoring transactions and implementing risk management practices. Real world example. The BCCI scandal 1980s-1991 is a prominent example of how the absence of strict anti-money laundering regulations led to the misuse of the banking system for criminal activities. The Bank of Credit and Commerce International BCCI, headquartered in Luxembourg, was involved in one of the largest and most significant money laundering scandals in history. How the bank was used. BCCI allowed individuals and entities involved in illegal activities such as arms dealing, drug trafficking, and bribery to conduct transactions through the bank. It provided secret accounts, helped launder billions of dollars, and facilitated illicit international financial transactions, often bypassing regulatory oversight. Failure of due diligence. At the time, BCCI's lack of effective Know Your Customer KYC procedures and its failure to monitor and report suspicious activities made it an ideal vehicle for money laundering. The bank used its global network to hide the origins of funds and evade detection. Outcome. The BCCI scandal led to the bank's eventual collapse in 1991, with $13 billion in debts, the loss of billions in customer deposits, and widespread public outrage. Investigations revealed extensive criminal activities, including aiding money laundering, and the bank's failure highlighted the vulnerabilities in the global banking system at the time. The scandal also led to a wider recognition of the need for stricter anti money laundering controls, prompting further regulatory action and the development of more robust frameworks, including the Financial Action Task Force FATF, 40 Recommendations 1990, which would address many of the gaps left by the 1988 Basel Framework. The evolution of AML standards post 1988. The Basel 1988 framework was a significant starting point in the fight against money laundering, but it was not enough to address the growing complexity of global financial crimes. As a result, this framework was superseded by more comprehensive and detailed regulations such as 1. FATF 40 Recommendations 1990 updated regularly. These recommendations formed a global standard for anti-money laundering measures, focusing on customer due diligence, suspicious activity reporting, record keeping, and international cooperation. 2. Basel II 2004 and Basel II 2010. The Basel Committee expanded its recommendations to include stricter regulations on risk management, capital adequacy, and liquidity, helping to prevent money laundering through enhanced financial stability measures. 3. The EU's anti-money laundering directives AMLD, the European Union developed and strengthened its AML frameworks through successive directives, requiring member states to establish rigorous regulations for financial institutions. Conclusion. While the 1988 Basel framework provided an early attempt to prevent the criminal use of the banking system for money laundering, its implementation was basic compared to today's more advanced regulatory systems. The BCCI scandal serves as a stark reminder of the consequences of inadequate anti money laundering practices. Since then, international efforts, led by organizations like FATF and subsequent Basel reforms, have significantly improved global AML standards. These measures now help ensure that financial institutions play an active role in preventing criminal activities, including money laundering, within the global banking system. Now, coming to this. The Core Principles for Effective Banking Supervision 1997. This is issued by the Basel Committee on Banking Supervision, are international guidelines aimed at ensuring that banks are well regulated, financially stable, and capable of managing risks. These principles have become a global benchmark to help maintain trust in the financial system and protect depositors' money. Let's break down the key points. 1. Supervisory authority. Each country must have a regulatory body like the RBI in India with the authority and power to oversee and monitor banks. This body ensures that banks are operating in a safe and sound manner, reducing risks to depositors and the overall financial system. Example, the RBI regulates all banks in India, ensuring they follow appropriate laws and risk management practices. 2. Licensing. Banks should only be allowed to operate after obtaining a license. This license is issued only when the bank meets specific standards regarding capital, management quality, and business plans. This ensures that only well structured and financially sound institutions operate as banks. Example, a new bank applying for a license must prove it has enough capital to handle risks and must have competent management to run the institution safely. 3. Capital adequacy. Banks must hold sufficient capital money set aside to cover potential losses from risky loans or investments. Having enough capital ensures the bank can absorb losses and still operate, preventing failures that could harm depositors. Example, after the 2008 financial crisis, Basel I introduced stricter capital requirements, ensuring banks have enough financial reserves to avoid another crisis. 4. Risk management. Banks face many risks, like borrowers defaulting on loans, credit risk, or fluctuations in financial markets, market risk. To stay stable, banks must have systems in place to identify, manage, and mitigate these risks. Example, a bank lending money to customers assesses each borrower's credit score and financial history to determine the likelihood of loan repayment, managing credit risk effectively. 5. Corporate governance. Banks should have strong internal governance, ensuring they are managed responsibly. This includes having a clear structure of decision making and avoiding conflicts of interest. Example, a bank's board of directors must ensure that management takes responsible actions that align with the bank's long term goals and stakeholder interests. 6. Anti money laundering ML, combating the financing of terrorism CFT. Banks must have policies in place to prevent illegal activities like money laundering and terrorist financing. This includes identifying suspicious transactions, verifying customers' identities (KYC), know your customer, and reporting any suspicious activity to the authorities. Example, if a customer makes a series of unusually large cash deposits, the bank's AML system should flag these transactions for further investigation. 7. Supervisory techniques. Supervisors regulators should regularly monitor banks both through on site inspections and off site data reviews. On site inspections involve visiting the bank to check its systems and controls, while off site reviews include analyzing reports, financial statements, and other data submitted by the bank. Example regulators may inspect a bank's records and controls yearly, while they continuously monitor financial statements to detect any signs of financial trouble. 8. Corrective actions. If a bank is found to be violating regulations or if it is at risk of failing, the regulator must have the authority to take corrective actions. These can include penalties, requiring changes in management, or even shutting down the bank to protect the financial system. Example, if a bank's capital falls below required levels, the regulator might instruct the bank to stop lending or replace its management team to fix the issues. Why are these principles important? Protecting depositors, they ensure that banks operate safely and responsibly, reducing the risk of losing depositors' money. Financial stability, strong supervision helps prevent bank failures, which could destabilize the economy. Global standards, these principles create a common framework that countries around the world can use to ensure their banking systems are secure and well regulated. In summary, the core principles for effective banking supervision provide a structured framework to ensure that banks are well regulated, financially sound, and capable of handling risks. They help maintain trust in the global financial system by ensuring that banks operate in a responsible and safe manner. Now coming this, the sharing of financial records between jurisdictions in connection with the fight against terrorist financing. This is a set of guidelines developed by the Basel Committee on Banking Supervision to help countries and financial institutions cooperate in combating the global issue of terrorist financing. The guidelines highlight the importance of sharing financial information across borders to prevent and detect terrorist activities, as terrorism financing is often cross jurisdictional and requires international coordination. This initiative came after the 9/11 attacks in 2001, which underscored the need for greater financial transparency and cooperation among countries to disrupt the financial networks of terrorist organizations. The guidelines aim to strengthen the anti money laundering AML and counter terrorist financing CFT frameworks by facilitating the sharing of financial information between different jurisdictions, countries, or regions to trace, freeze, and confiscate funds used for terrorism. Detailed explanation of the framework. The framework outlined in April 2002 emphasizes several critical principles. 1. International cooperation and information sharing. Principal jurisdictions must work together by sharing financial records and intelligence to trace the flow of funds used for terrorist activities. Cross border cooperation is essential because terrorist organizations often operate across multiple countries. Real example, following the 9/11 attacks, global authorities discovered that terrorists used international financial systems to fund their operations. For instance, Al Qaeda had accounts and transactions in various countries, including the US, Germany, and the UAE. International collaboration between financial intelligence units FIS, such as the FBI and FinCEN Financial Crimes Enforcement Network, help trace and disrupt funding channels. 2. Transparency of financial transactions. Principal financial institutions must implement systems to ensure transparency of financial transactions, enabling authorities to track and identify suspicious activities related to terrorism financing. Real example, the SWIFT network, used for international money transfers, was targeted post 9/11 for its role in allowing terrorists to move money globally. The US Treasury Department accessed SWIFT's financial data to monitor suspicious international transactions related to terrorism financing. 3. Due diligence by financial institutions. Principal banks and other financial institutions must implement Know Your Customer KYC and Customer Due Diligence CDD procedures to detect and prevent accounts and transactions linked to terrorist financing. These procedures help institutions identify suspicious behavior and flag it for further investigation by authorities. Real example in the Loomis case, the US. Government froze accounts linked to Al Qaeda after it was discovered that the network used Hawala, an informal remittance system, to transfer money. Financial institutions were compelled to conduct thorough due diligence to identify individuals involved with such networks. 4. Legal and regulatory framework for sharing information. Principal jurisdictions must have laws that allow financial information related to terrorist financing to be shared with foreign authorities in a legal and secure manner. This includes ensuring that data protection and privacy laws are balanced with the need for transparency in counter-terrorism efforts. Real example, the European Union's fourth Anti-Money Laundering Directive 2015 required member states to create frameworks that allow information sharing among national authorities and financial institutions in line with the EU's broader efforts to counter terrorism financing. Additionally, the USA Patriot Act enabled US authorities to share financial intelligence with other countries, facilitating international cooperation in tracking funds linked to terrorism. 5. Use of financial intelligence units FAIRs. Principal countries should establish financial intelligence units FIRES to analyze financial data, identify suspicious transactions, and facilitate the sharing of financial information with other jurisdictions. These units play a crucial role in tracking and disrupting terrorism financing by monitoring financial transactions and cooperating with international counterparts. Real example, the Egmont Group, an international network of FIRES, helps coordinate information sharing and collaboration between jurisdictions. After the 9/11 attacks, the Egmont Group facilitated the exchange of financial intelligence that helped identify terrorist financiers and disrupt terrorist networks globally. 6. Freezing and confiscating terrorist assets. Principal authorities should have the ability to freeze and confiscate assets suspected of being linked to terrorist activities. This can include both domestic and international assets, requiring effective legal mechanisms and international cooperation to seize funds across borders. Real example, the UN Security Council Resolution 1373-2001 required all member states to freeze asset sets and prevent financial support for individuals and organizations linked to terrorism. The US Treasury and the UN worked together to freeze the assets of individuals such as Osama bin Laden and groups like Al Qaeda, preventing them from accessing global financial systems. 7. Coordination with law enforcement and intelligence agencies. Principal financial regulators and authorities should coordinate with law enforcement and intelligence agencies to enhance the detection and investigation of terrorist financing. This ensures a comprehensive approach to identifying and dismantling terrorist financing networks. Real example, the FBI, CII, and Interpol often work in tandem with financial institutions and regulatory bodies to track and intercept financial transactions linked to terrorism. For example, in Operation Green Quest, US. Authorities, in collaboration with international agencies, used financial intelligence to identify and disrupt funding networks for Hamas and Al Qaeda. Real world example, the Operation Green Quest. One of the most significant real world examples of international financial information sharing in the fight against terrorist financing was Operation Green Quest. This operation, led by the US Treasury Department, involved multiple international law enforcement agencies and financial regulators, and it targeted the financial infrastructure of groups linked to terrorism, such as Hamas, Al Qaeda, and the Taliban. Details in the early 2000s, after the 9/11 attacks, the US government initiated this multi-agency operation to track down individuals and organizations suspected of financing terrorism. The operation focused on gathering financial intelligence, freezing assets, and dismantling terrorist financing networks. International cooperation through financial intelligence units FIS and international law enforcement agencies, information was shared across borders, allowing the US to work with countries in the Middle East and Europe to freeze accounts and seize assets linked to terrorist organizations. Outcome: as a result of the operation, numerous individuals and entities were sanctioned or arrested, and their assets were frozen globally. This action significantly disrupted the ability of terrorist organizations to fund their activities, demonstrating the power of financial intelligence sharing and cross border cooperation in the fight against terrorist financing. Conclusion. The April 2002 Basel Framework on the sharing of financial records between jurisdictions for the fight against terrorist financing laid the groundwork for enhanced international cooperation and information sharing in counter-terrorism efforts. Through mechanisms like KYC, fierce legal frameworks, and international cooperation, countries and financial institutions are better equipped to detect, freeze, and confiscate assets linked to terrorism. Post 9/11, various global initiatives, such as the UN Security Council Resolution 1373 and Operation Green Quest, have demonstrated the success of these principles in disrupting terrorist financing. Now, coming to this, due diligence and transparency regarding cover payment message related to cross border wire transfer. The General Guide to Account Opening and Customer Identification February 2003 was issued by the Basel Committee on Banking Supervision as part of its efforts to combat money laundering and terrorist financing. The guidelines aim to help financial institutions improve their practices in opening accounts and identifying customers, ensuring that they could prevent the misuse of the banking system for illegal activities. The framework laid out the principles and procedures for Know Your Customer KYC and Customer Due Diligence CDD, which are key elements in protecting financial institutions from being exploited for criminal purposes. These guidelines were later superseded by updated recommendations from the Financial Action Task Force FATF and other regulatory bodies, but the 2003 Basel guidelines were pivotal in establishing the foundation for modern banking regulations. Key principles of the 2003 Basel Guidelines. 1. Customer Identification Program CP. Principal financial institutions must develop and implement effective customer identification program CP to ensure that the individuals or entities they do business with are properly identified and verified. This is the first step in KYC and is essential in preventing fraud, money laundering, and terrorist financing. Details institutions must collect and verify essential information from customers such as O full name, O date of birth for individuals, O address, O identification number e.g. passport number, national ID or tax number, O legal status for businesses or entities. Real example after the 2001 terrorist attacks, it became evident that terrorist organizations were using the financial system to move funds. For instance, Al Qaeda operatives used false identities to open bank accounts and transfer money. The customer identification programs helped banks identify and block such fraudulent accounts, reducing the risk of facilitating terrorism financing. Now, coming to this, due diligence and transparency regarding cover payment message related to cross border wire transfer. The General Guide to Account Opening and Customer Identification February 2003 was issued by the Basel Committee on Banking Supervision as part of its efforts to combat money laundering and terrorist financing. The guidelines aim to help financial institutions improve their practices in opening accounts and identifying customers, ensuring that they could prevent the misuse of the banking system for illegal activities. The framework laid out the principles and procedures for Know Your Customer KYC and Customer Due Diligence CDD, which are key elements in protecting financial institutions from being exploited for criminal purposes. These guidelines were later superseded by updated recommendations from the Financial Action Task Force FATF and other regulatory bodies, but the 2003 Basel guidelines were pivotal in establishing the foundation for modern banking regulations. Key principles of the 2003 Basel Guidelines. 1. Customer Identification Program (CP). Principal financial institutions must develop and implement effective customer identification programs (CP) to ensure that the individuals or entities they do business with are properly identified and verified. This is the first step in KYC and is essential in preventing fraud, money laundering, and terrorist financing. Details institutions must collect and verify essential information from customers such as O full name, O date of birth for individuals, O address, O identification number e.g. passport number, national ID or tax number, O legal status for businesses or entities. Real example after the 2001 terrorist attacks, it became evident that terrorist organizations were using the financial system to move funds. For instance, Al Qaeda operatives used false identities to open bank accounts and transfer money. The customer identification programs help banks identify and block such fraudulent accounts, reducing the risk of facilitating terrorism financing. 2. Customer Due Diligence (CDD). Principal banks must perform customer due diligence (CDD) to assess the risk profile of the customer. This includes understanding the purpose of the account, the source of funds, and the expected volume and type of transactions. Details CDD involves O. Verifying the identity of customers (KYC). O. Understanding the nature of the business and expected account activity. O. Conducting ongoing monitoring of the account to detect unusual or suspicious transactions. Real example in the case of the Russian money laundering scandal 2009, where billions of dollars were funneled from Russia to offshore accounts, financial institutions in Latvia and Estonia failed to properly assess the source of funds and the purpose of transactions. A more rigorous CDD program could have identified these transactions as suspicious and flagged them for further investigation. 3. Risk-based approach. Principal financial institutions should adopt a risk-based approach to customer identification and due diligence. This means that the level of scrutiny applied during account opening and transaction monitoring should be proportional to the perceived risk associated with the customer. Details higher risk customers, such as those from high risk countries or those engaged in high risk businesses, require more thorough due diligence. On the other hand, low risk customers may undergo simpler procedures. Real example for example, banks in the United Arab Emirates (UAE) adopted a risk-based approach after facing scrutiny over the influx of illicit funds from Iran and Pakistan. UAE banks implemented enhanced KYC and due diligence procedures when dealing with customers from high-risk countries. In 2019, HSBC was penalized for failing to apply sufficient CDD to high-risk clients, including transactions with clients linked to terrorist financing and money laundering, which led to $1.9 billion in fines. 4. Ongoing monitoring of transactions. Principal financial institutions must continuously monitor customer transactions after the account is opened to ensure that the activity matches the expected profile. This is critical for detecting suspicious or unusual transactions that might indicate money laundering or terrorist financing. Details ongoing monitoring includes 1. Reviewing account transactions for suspicious patterns. 2. Reporting suspicious transactions to the authorities. 3. Keeping track of significant changes in the customer's behavior, such as large unexplained transfers. 4. Real example in 2016, Deutsche Bank was fined over $630 million for facilitating the movement of $10 billion of Russian money through its mirror trading operation. These transactions were flagged as suspicious, but the bank's internal monitoring and reporting systems were insufficient, allowing the illicit transfers to occur undetected for a prolonged period. 5. Verification of source of funds. Principal banks must verify the source of funds for certain high risk customers or transactions. This is a crucial step in preventing money laundering and ensuring that criminal funds do not enter the financial system. Details this involves asking customers to provide documentation or evidence about the origin of their funds, especially for large or irregular transactions. Real example during the Panama Papers scandal in 2016, it was revealed that offshore companies were used to conceal the ownership of assets and avoid taxes. Banks that failed to verify the source of funds or account ownership were implicated, such as Danske Bank, which was linked to EUR 200 billion in suspicious transactions due to inadequate verification processes. 6. Enhanced due diligence AD for high risk customers. Principle for high risk customers, such as politically exposed persons PEPs, individuals from high risk jurisdictions, or customers with complex ownership structures, banks must apply enhanced due diligence aided procedures. Details aid involves deeper scrutiny, including gathering additional information about the customer's background, source of funds, and the purpose of transactions. It may also involve close monitoring of their accounts. Real example in the 1MDB scandal 2015, banks involved in the fund transfers, such as Goldman Sachs, were criticized for failing to apply AD for high profile individuals linked to the Malaysian government, enabling the illicit flow of funds estimated at $4.5 billion. Real world example, the Russian laundromat case. The Russian laundromat case is an example of how KYC, CDD, and ongoing monitoring could prevent the use of the banking system for money laundering. In this case, $20 billion was transferred out of Russia through a network of shell companies and banks across Europe, primarily through Latvia and Estonia. The banks involved failed to conduct thorough customer identification and due diligence, allowing criminals to launder the money. In response, the Basel Committee's 2003 guidelines called for stronger practices in customer identification, enhanced due diligence, and ongoing transaction monitoring to prevent such abuses. Conclusion. The General Guide to Account Opening and Customer Identification 2003 laid the foundation for current banking regulations regarding KYC-CDD and MLCFT practices. It emphasized the need for robust identification and verification procedures, including understanding the source of funds and monitoring customer activity. Real world examples like the Russian laundromat, Deutsche Bank's mirror trading, and the Panama Papers illustrate how failing to implement these principles can result in severe financial crimes and regulatory penalties. These guidelines continue to shape modern banking practices and help institutions protect themselves against financial crimes. Now, fourth, the due diligence and transparency regarding cover payment messages related to cross border wire transfers, May 2009, was a set of guidelines issued by the Basel Committee on Banking Supervision to address concerns about money laundering, terrorist financing, and other financial crimes in international wire transfers. These guidelines were developed in response to the growing realization that cross border wire transfers were often used to move illicit funds, including those linked to terrorist organizations, criminal networks, and sanctioned individuals or entities. The goal of these guidelines was to improve the transparency and due diligence practices associated with cross border payments, particularly regarding the cover payment messages used in these transactions. Key principles of the 2009 guidelines. 1. Cover payment messages and their role. Principal cross-border wire transfers often involve two financial institutions, one initiating the transfer and the other receiving it. In some cases, the payment message may be covered by a payment from a third institution, such as an intermediary. Cover payments are used to complete these wire transfers when there are different intermediaries involved. Issue in many cases, cover payment messages didn't contain complete information about the parties involved in the transaction, which created opportunities for money laundering and terrorist financing. The lack of transparency in these transactions made it difficult for authorities to trace illicit funds. Real example, Al Qaeda operatives have been known to use cross-border wire transfers through cover payment systems to fund their activities. These payments were often routed through multiple intermediary banks, obscuring the true origin and destination of the funds. For example, during the 2003 terrorist bombings in Saudi Arabia, funds sent to terrorists via cover payments were traced to multiple intermediaries in Europe and the Middle East, making it difficult for authorities to follow the money trail. 2. Due diligence and customer information. Principal financial institutions involved in cross border payments must perform due diligence to ensure they have accurate and complete customer information for both the sender and recipient of the transfer, including the details of the payment. Details the guidelines require banks to ensure that all full customer details, name, account number, address, and other identifying information are included in the payment message for both the originator and the recipient. O intermediary banks should also transmit this information in a clear and transparent manner to ensure that all parties in the transaction have access to the same data. Real example in 2012, HSBC was fined $1.9 billion for its failure to properly monitor cross-border transactions, including cover payments linked to Mexico's drug cartels. The lack of due diligence and incomplete customer information in wire transfers allowed criminal organizations to launder money across borders without detection. 3. Transparency in cross-border payments. Principal financial institutions must ensure that cover payments related to cross-border wire transfers include sufficient details to provide transparency. This helps authorities trace transactions and prevent illegal activities. Details to ensure transparency. The guidelines recommend that banks O maintain records of the origin and destination of the funds. O ensure that the cover payment messages contain enough information to trace the transaction back to the parties involved. O establish robust systems to monitor for suspicious activities related to cross-border transfers. Real example, following the 2001 and 9/11 attacks, authorities realized that the terrorist organization Al Qaeda had been using cross-border wire transfers, inadequate transparency to fund operations. In response, the US Treasury and FATF began implementing stricter requirements on SWIFT, the global financial messaging network, to improve the transparency of international payments and facilitate the detection of suspicious transactions. 4. Complying with sanctions and regulations. Principal financial institutions must ensure that cover payment messages comply with national and international sanctions and regulatory frameworks. This includes verifying that funds are not being sent to sanctioned individuals, terrorist groups, or criminal organizations. Details financial institutions must use sanction screening tools to verify that the transaction does not involve parties listed on international sanction lists, e.g., those maintained by the UN US Treasury. Institutions are required to refuse or block transactions that involve sanctioned entities. Real example in 2014, Standard Chartered was fined $300 million for processing transactions that violated US sanctions against Iran. The bank failed to properly monitor cover payment messages in cross-border transfers, allowing funds to flow to sanctioned entities. In one case, a transaction involved a US dollar payment from Iran routed through an intermediary bank in Europe, bypassing US sanctions. 5. Monitoring and reporting suspicious transactions. Principal banks should have systems in place to monitor cross border transactions and report suspicious activity related to cover payments. Details the guidelines emphasize that financial institutions must implement monitoring systems capable of detecting patterns or irregularities that suggest potential money laundering or terrorist financing. Institutions should report suspicious transactions to the relevant financial intelligence units (FIUs). Real example in 2015, Deutsche Bank was fined $630 million for enabling the Russian money laundering scheme, where large sums of money were transferred out of Russia through mirror trading and cover payment methods. The bank's monitoring systems failed to flag these suspicious transactions, which were routed through several intermediary banks, making it difficult for authorities to trace the origin and purpose of the funds. 6. Global standards and cooperation. Principle the guidelines also encourage global cooperation and the adherence to international standards for transparency and due diligence in cross border wire transfers. This includes aligning with FATF recommendations and UN Security Council resolutions. Details countries and financial institutions must adhere to international standards for combating money laundering and terrorism financing and work together to prevent illicit financial flows. Real example, the US's fourth Anti-Money Laundering Directive 2015 implemented regulations that required member states to increase transparency in cross-border payments. The directive specifically targeted cover payment messages, ensuring that all transfers between EU countries were properly documented and transparent, preventing money laundering and terrorist financing. Conclusion. The May 2009 Basel Guidelines on Due Diligence and transparency regarding cover payment messages in cross-border wire transfers were critical in enhancing global efforts to detect and prevent illicit financial flows. By ensuring that cover payment messages are transparent, complete, and comply with legal requirements, financial institutions can play a key role in safeguarding the financial system from exploitation by criminals, money launderers, and terrorist financiers. Real life cases like HSBC's failure to monitor money laundering activities and Standard Chartered's violation of US sanctions highlight the importance of these guidelines in preventing financial crimes. Through improved transparency, monitoring, and cooperation, these guidelines aim to close loopholes and ensure that the global financial system remains secure and transparent. The due diligence and transparency regarding cover payment messages related to cross border wire transfers, May 2009 was a set of guidelines issued by the Basel Committee on Banking Supervision to address concerns about money laundering, terrorist financing, and other financial crimes in international wire transfers. These guidelines were developed in response to the growing realization that cross border wire transfers were often used to move illicit funds, including those linked to terrorist organizations, criminal networks, and sanctioned individuals or entities. The goal of these guidelines was to improve the transparency and due diligence practices associated with cross border payments, particularly regarding the cover payment messages used in these transactions. Key principles of the 2009 guidelines. 1. Cover payment messages and their role. Principal cross-border wire transfers often involve two financial institutions, one initiating the transfer and the other receiving it. In some cases, the payment message may be covered by a payment from a third institution such as an intermediary. Covered payments are used to complete these wire transfers when there are different intermediaries involved. Issue in many cases, cover payment messages didn't contain complete information about the parties involved in the transaction, which created opportunities for money laundering and terrorist financing. The lack of transparency in these transactions made it difficult for authorities to trace illicit funds. Real example, Al Qaeda operatives have been known to use cross border wire transfers through cover payment systems to fund their activities. These payments were often routed through multiple intermediary banks, obscuring the true origin and destination of the funds. For example, during the 2003 terrorist bombings in Saudi Arabia, funds sent to terrorists via cover payments were traced to multiple intermediaries in Europe and the Middle East, making it difficult for authorities to follow the money trail. 2. Due diligence and customer information. Principal financial institutions involved in cross border payments must perform due diligence to ensure they have accurate and complete customer information for both the sender and recipient of the transfer, including the details of the payment. Details the guidelines require banks to ensure that 1. Full customer details name, account number, address, and other identifying information are included in the payment message for both the originator and the recipient. 2. Intermediary banks should also transmit this information in a clear and transparent manner to ensure that all parties in the transaction have access to the same data. Real example in 2012, HSBC was fined $1.9 billion dollars for its failure to properly monitor cross border transactions, including cover payments linked to Mexico's drug cartels. The lack of due diligence and incomplete customer information in wire transfers allowed criminal organizations to launder money across borders without detection. 3. Transparency in cross border payments. Principal financial institutions must ensure that cover payments related to cross border wire transfers include sufficient details to provide transparency. This helps authorities trace transactions and prevent illegal activities. Details to ensure transparency, the guidelines recommend that banks first, maintain records of the origin and destination of the funds. Second, ensure that the cover payment messages contain enough information to trace the transaction back to the parties involved. Third, establish robust systems to monitor for suspicious activities related to cross border transfers. Real example following the 2001 and 9/11 attacks, authorities realized that the terrorist organization Al Qaeda had been using cross border wire transfers with inadequate transparency to fund operations. In response, the US, Treasury, and FATF began implementing stricter requirements on SWIFT, the global financial messaging network, to improve the transparency of international payments and facilitate the detection of suspicious transactions. Now, coming to the Financial Action Task Force FATF. This is an intergovernmental organization established in 1989 to develop and promote policies to combat money laundering, terrorist financing, and other threats to the integrity of the international financial system. FATF sets international standards for anti-money laundering (AML) and countering the financing of terrorism (CFT), and works with governments and financial institutions worldwide to ensure compliance with these standards. Key points about FATF. 1. Purpose and goals. FATF's primary goal is to protect the global financial system from being used for illegal activities such as money laundering and terrorist financing. It aims to establish effective legal, regulatory, and operational measures to fight financial crimes. 2. FATF recommendations. FATF publishes a series of recommendations that countries must follow to ensure robust AML and CFT systems. These include standards on customer due diligence (CDD), reporting suspicious transactions, and implementing sanctions. FATF recommendations. The 40 FATF recommendations are the international AML CFT standards, which cover a range of areas including customer identification and due diligence, record keeping, reporting of suspicious transactions, cooperation with law enforcement, freezing and confiscating terrorist assets, ensuring financial institutions know their customers and their customers' activities. 3. Mutual evaluations. FATF conducts mutual evaluations to assess the effectiveness of member countries' AML CFT frameworks. This process helps to determine whether a country has adopted the FATF recommendations and how effectively it implements them. Example: if a country fails to meet FATF standards, it may be placed on the FATF grey list or blacklist, which can have economic consequences such as limited access to international financial markets. 4. Membership. FATF has 39 members, including countries and regional organizations, and 2 observer members. Member countries are responsible for implementing FATF's recommendations and ensuring compliance in their financial systems. 5. Global reach. FATF works with regional bodies such as the Asia Pacific Group and Egmont Group of Financial Intelligence Units FIUS to enhance global cooperation in the fight against financial crimes. 6. Addressing emerging threats. FATF regularly updates its guidelines to address new challenges in the financial world, such as cryptocurrencies, fintech, and the evolving tactics of terrorist financing. Real world example. A significant FATF impact occurred when countries like Iran and North Korea were placed on the blacklist due to inadequate measures to combat money laundering and terrorist financing. This led to international sanctions limiting these countries' access to the global financial system. FATF's influence in enforcing compliance has made it a central authority in the fight against global financial crimes. In summary, FATF's role is essential in setting international standards for combating money laundering and terrorism financing and ensuring financial institutions worldwide adopt effective regulatory and compliance measures. Now, coming further, AFATF standards. The FATF standards consist of the 40 recommendations that are internationally recognized guidelines designed to combat money laundering (AML) and counter-terrorism financing (CFT). These recommendations outline the actions and measures that countries should implement to ensure their financial systems are not used for illicit activities. The FATF standards cover areas such as customer due diligence (CDD) and know your customer requirements, reporting of suspicious transactions, record keeping for financial transactions, international cooperation in financial crimes investigations, implementation of measures to prevent terrorism financing and the use of financial systems for criminal activities. These standards aim to promote a global effort in preventing financial crimes, ensuring that financial institutions adopt robust systems to detect and report illegal activities. B. FATF statement highlighting deficiencies in the AML CFT systems in certain jurisdictions. FATF regularly issues statements highlighting deficiencies in a country's anti-money laundering (AML) and counter-financing of terrorism (CFT) frameworks. These statements are typically directed at countries that fail to meet FATF standards for combating financial crimes. Countries identified with deficiencies may face increased scrutiny and international pressure to improve their systems. Example: when FATF placed Iran and North Korea on its blacklist for failing to comply with international standards, it was a strong statement urging these countries to reform their AML CFT systems. Countries on FATF's blacklist or grey list, a list of countries under enhanced monitoring, often face financial isolation and limited access to global financial markets. These statements not only indicate weaknesses but also provide recommendations and deadlines for these countries to address the issues. Failure to comply can lead to sanctions or restrictions from the global financial community. C. High risk and non cooperative jurisdictions. FATF identifies certain countries as high risk or non cooperative when their AML CFT frameworks fail to meet global standards. This category includes 1. High risk jurisdictions, countries that are seen as having serious weaknesses in their ability to combat financial crimes but are working to make improvements. These countries are typically placed under enhanced monitoring by FATF. Example: countries like Pakistan were placed on the grey list because of weak controls over terrorism financing, but over time they made significant improvements to address these concerns. 2. Non-cooperative jurisdictions, countries that are either unwilling or unable to address serious deficiencies in their ML safety systems. These jurisdictions are often placed on the blacklist, which means they are subject to severe financial restrictions from the global community. Example: North Korea and Iran are examples of countries that were placed on FATF's blacklist for being non-cooperative and failing to implement international MLCFT standards. Countries on the blacklist face international sanctions, including limitations on financial transactions and access to global financial markets. 3. Mutual evaluation of countries. The mutual evaluation process is one of FATF's primary tools to assess how well countries have implemented and are adhering to its standards. This peer review system evaluates the effectiveness of a country's AML-CFT framework and measures its compliance with FATF's 40 recommendations. How it works: FATF conducts these evaluations through a series of on site visits, documentation reviews, and discussions with national authorities and financial institutions. A comprehensive report is produced which highlights strengths, weaknesses, and areas for improvement in a country's MLCFT system. Example: a mutual evaluation of India might examine the effectiveness of its Financial Intelligence Unit, the country's regulatory framework for financial institutions, and the capacity of law enforcement agencies to investigate money laundering and terrorism financing cases. After the evaluation, countries receive recommendations to improve their systems, and FATF monitors their progress in addressing identified weaknesses. If a country fails to implement necessary changes, it could be placed on the grey list or blacklist. Conclusion: 1. FATF standards provide the global framework for combating financial crimes such as money laundering and terrorism financing. 2. FATF statements on deficiencies help identify countries that are lagging in AML-CFT efforts and urge them to reform their systems. 3. Countries that do not comply with FATF standards can be classified as high risk or non cooperative, facing restrictions from the global financial community. 4. Mutual evaluations ensure that countries are regularly assessed for compliance with FATF standards, promoting transparency, accountability, and international cooperation in fighting financial crime. So, we have completed part 1 of this chapter 4 and learned Basel Committee on Banking Supervision and FATF. Please watch part 2 of this chapter. Then, after, we will learn MLCFT legislation in major countries and region. Thank you so much for watching.